This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of Monday, June the 13th, 2022. A week that we figured was going to be pretty challenging, given that it is a June FOMC was going to be in the middle of the week. Everybody was expecting at least a 50 basis point Fed funds rate hike. Usually that's not beneficial for higher gold prices, that's for sure. But as the week began, all of a sudden speculation started to grow that there'd be a 75 basis point rate hike, given the CPI action the previous Friday. And so here went the bond market, rates spiking as bonds sold off sharply. And of course, higher nominal yields, usually not good for gold. So we took a look at the bond market as part of what we discussed on Monday, June the 13th. All right, here's the 2-year note. These are just hourly candles, all right? You can see where today it got to 342. You can also see where prior to the CPI being released, it was 285. 50 basis points in 2 days. The nice, quiet, sleepy, kind of commercial paper-ish, overnight funding, money market level, 2-year notes. 50 basis points in 2 days. Look at the 10-year note. 305 back on Friday morning. Today hit 345. And like I said, now flat with the 2-year. Little bit of a safe haven bid this afternoon because it got to 344, fell back to 338 because stocks are so in the tank. So as that continues, you are going to see an inverted yield curve because the 2-year note is going to continue to soar. And the 10-year note might actually catch a bid as the stock market crashes. Now, again, and remember we talked about this when we were talking, well, maybe the 10-year note has itself a little head and shoulders top. Maybe it's going to pull back 2.5, but maybe it's going to go to 4% because there's nothing to stop it from doing so. If the Fed's not buying and Japan is selling, who's left? Right? It's like Lagarde last week talking about, fragmentation. We got to defend the pigs. Because if she doesn't buy Portuguese or Italian or Greek or Spanish debt, then nobody will. They are now the market. The ECB is. As is the Fed, and they're trying to pretend like they're not. My God. Tuesday, June the 14th, brought another discussion of the bond market as a massive sell-off continued, and the yield on the 10-year note began to approach 3.5%. Huge moves in just a couple of days across the Treasury yield curve. This, of course, has implications for the U.S. economy, the housing market, but also higher nominal rates make real interest rates go up as well, and that's always a key driver for gold. So we've got to always keep an eye on the bond market, and that discussion continued, again, Tuesday, June the 14th. Look at the 10-year note. 1 year ago, 144. Now, 349. Now, again, that move in nominal rates impacts gold. And you would think, okay, we're still even on a current basis, sharply negative real rates. But 349 now exceeds even those inflation expectations that had been bumped up last Friday in the UMich survey data. So that's all part of what's weighing on gold. No doubt about it. So look at some of the history of this. This is somebody put this on Twitter. Just how remarkable this is. The 10-year yield rose. That's 11 basis points to 348. Like I said, I got 349. Yield is up for 5 consecutive days. It's up 51 basis points in the last 5 trading days. Longest winning streak. That's ridiculous to say it that way. That's the biggest sell-off, longest sell-off since April of 2022 when it sold off for 7 straight days. Yield is up 9 of the past 11 days, new 52-week high. Highest yield in the 10-year note since April 14th of 2011. And then you can see all the rest. Crazy. Wednesday, June the 15th brought the conclusion of the June FOMC meeting, the Fed lines, and of course, Chairman Powell's press conference, Well, there was an important moment about 6 or 7 minutes in where Powell admitted that they don't have a plan, and then nobody can really project where we're going to be in 6 or 12 months. At that point, the dollar began to sell off and gold began to soar. And all of a sudden, gold, silver, and the GDX, the big minor ETF, started looking that maybe, just maybe, there might be a double bottom on the chart. So that was one of the charts we looked at. Again, Wednesday, June the 15th. Today, we're going to start with the GDX. Why? Because the GDX, even though today's candle is not too good, because it opened higher, because gold had kind of traded higher overnight, then dumped, and then never came all the way back. So it's still a red candle with or really kind of a red hammer thingy. But again, finding support in this area between 29 and 30, like it has on multiple occasions going back to last summer. But remember we were talking last week about this concept, this technical TA thing of a positively divergent lower low, okay? Where you make a lower price low, but you don't confirm that with lower RSI. In fact, the RSI is actually higher the next time. You can see that on this GDX chart. RSI in the GDX got like to 23 or 4 in the middle of May when we came down to 29.5. Well, these last couple of days, we've gotten down to even lower than that, but yet the RSI is 39. Okay? So there's your divergent lower low. That's typically a sign of a bottom. And you could also look at that and begin to see perhaps a double bottom, right? Well, we'll see. I mean, anything can happen, obviously. I mean, we could all shit the bed tomorrow and finish below 29 by Friday. However, as most of this TA stuff with the benefit of hindsight gets confirmed, if we begin moving higher now, the rest of this month and into July, and eventually we get higher than 33, that get higher than that high a couple weeks ago at 33.5, we're going to look back and go, there it was. There's your positively divergent lower low. And now we're breaking higher in a double bottom. Just wanted to give you that little bit of hope. Okay? A sharp sell-off in the U.S. dollar index did provide some hope on Thursday the 16th, as gold rallied nearly $30 and back above its 200-day moving average. Gold, too, starting to have a look of a double bottom on its chart, and that was something we discussed on Thursday. All right, gold on the daily chart. Again, if you didn't listen to yesterday's podcast, miss a day, miss a lot. You might just go back. The last 4 or 5 minutes is where we talked about the potential for double bottoms. We started with the GDX because that was the one that actually made a positively divergent lower low. We talked about that yesterday. But again, looks like it had double bottom, just like you could maybe make the same case for gold and almost kind of for silver. So now, after today's action, where are we? Again, 1857. I printed this at 1855. Back above the 200-day moving average. So now let's talk about what's happened in the last month. We broke down through the 200-day moving average in mid-May. Washed out on a Monday morning to 1785 or 1790. Unlike the first trades in London, 7 o'clock London time, 2 o'clock in the morning in New York time on a Monday. Recovered. Found this little base down here. I don't know where you want to call it, 1810, 1805, something like that. Went back up the 200-day, fell, got above the 200-day, and then banged up against 1860 and 1880 for the better part of 3 weeks, till plunging back on Monday. And then where did we bottom? Same level. And now we're back above the 200-day moving average again. Sets up now. Again, as I told you yesterday, thing about calling a double bottom, you can only call it in hindsight. You can't, with any good faith, come down and as it happens say, I'm calling a double bottom. You're just guessing. Okay, so anybody that says, I called it. No, you didn't. You just got lucky. Okay? What happens now, and what we want to see happen, is next week, get back above, now start moving above 1880, and by then, that trend line from the March highs and the April highs. We get above there. Now, I'm not saying, and I'm not even telling you we're gonna, but if we do, then we look back and go, there it is. Look at that beautiful double bottom. And we'll be starting to target 1920 and beyond. So we'll see. And on Friday, June the 17th, gold reversed all of its gains, or most all of its gains, from Thursday. Looks like it's going to finish down on the week a rather substantial amount of about 2%, and back below its 200-day moving average. What happened? Well, after the sharp sell-off in the dollar index on Thursday, the dollar turned and reversed all of those losses on Friday. And so the machines, the pre-programmed algorithm high-frequency trading machines that control about 70 to 80% of the daily volume on COMEX, those machines that bought COMEX gold futures yesterday on the falling dollar turned right back around and sold COMEX gold today. So as we wrap up the week, again, kind of a gnarly red candle. However, and if anything, we continue to trace out a pattern of higher lows and also remain above the critical 50-week moving average. And I say critical because, well, you can see for yourself on this final chart of the week how much that plays a role in the intermediate term trend of gold. If we stay above that 50-week, we got a shot to start moving higher again. And we have a shot to start moving higher again as soon as next week. So come back next Friday and give a listen to your weekly podcast highlights. We discuss a lot more than just gold and silver every day with our 20-minute summary podcast. You should become a member at TF Metals Report and check us out. It's only $15 a month, and I think you'll find it's money well spent. Again, we'll talk to you again next Friday. Between now and then, though, have a great weekend, and thanks for listening to the TF Metals Report podcast highlights.